Hey, welcome everybody to another Ask Me Anything. Brian Fouch here with the BYOB team. We'll go ahead and go around the horn here in just a moment and get some introductions going, but go ahead and get those questions into the chat box and we'll see you guys in 14 seconds. All right, welcome back, everybody. So go ahead and get those questions into the chat box for this Ask Me Anything. So for those of you that this is your first time to this episode or Ask Me Anything, this is for you guys to ask questions about obviously infinite banking, anything financial related, market related, investments, whatever you want. Go ahead and ask those questions. Also, we have a special event starting here tomorrow, our 3-day blueprint event. So we're going to go ahead and put the link to that in the chat box as well here in just a moment. If you guys have not been to one of our 3-day events, it is a must attend if you want to learn about, obviously infinite banking is one of our big things, but we invite presenters and experts on all different topics and come and present to that event. So definitely go and check out the link here in just a moment once we get that in there. But for everybody who doesn't know me, I'm Brian Fouts up here in North Idaho, and I've been breaking out the tractors the last few days, kind of trying to pretend to be a farmer, but clearing a lot of debris, a lot of stuff from the wintertime, but that's what I've been busy doing. So with that, I'll pass it over to, I think, is it Linus? I think you're next.
Hey, Brian, I look pretty good with a monocle.
Yeah, you don't see Sandy up there.
I mean, I look like the BYOB guy. This is awesome.
So, oh, you look like you're almost 50 years old now.
Anyways, hi, I'm Mr. BYOB, and it's nice to meet everybody. Go ahead, Linus.
Absolutely. Yeah, Linus Nolt here from Hopkinsville, Kentucky. Happy to be here, help answer any questions and provide insights that I can. So this started out in, what was it, 2020, Stephen, as a kind of a Ask Me Anything happy hour. So everybody had a beer, had something or another. I'm here with Verna's Lemonade.
I thought you were going to hold a beer.
Not alcoholic. No, not alcoholic. But don't ask me how tart it is. All right. I wanted to throw out a plug here as well for the book itself, Becoming Your Own Banker by R. Nelson Nash. Ooh. Y'all out there, if you do not have it, go to Amazon and pick it up. It's like $22. And I recommend getting in there. Like if you're new to it, go in there, get started on page, I think it's 85.
I love that page.
Points to consider. Start there before you start the book. It's so much easier.
What's on page 85, Stephen?
One of the best parts, Linus just said.
What is it?
Points to consider chapter. Oh. Yeah. It helps people to start there before reading the entire book.
He knew that.
Love it. Love it.
All right, let me pass it on to Tess.
Hey, I'm Tess, and I'm not going to tell you what is in this 64-ounce container. I try to get a couple of them in a day, but it's a secret. I'm not telling. And so if I get sloppy towards the end, you'll figure it out. Anyways, for me, I'm going to say this 3-day blueprint training is the place that I started. It's a lot of information. If you're anything like me, when I first got around this campfire, I was overwhelmed, even though insurance has been my life for 35 years. This didn't resonate with me because I wasn't familiar with it. So I took the blueprint training and found one thing each time we had a session and made a change that way. So one thing at a time over the course of several years, and look where I ended up. Never thought I would be on this side of it. So thank you for being here. And who is next? I think it's Kevin.
Sweet. Thanks, Tess. Thanks, everybody. Obviously, welcome to another Ask Me Anything. I'm Kevin Krause, upstate New York, not too far from Joe and the team. Looking forward to answering any questions that everybody has. But this is definitely, just like Tess said, it's definitely an amazing event, something I did as well. Got started that, and one at a time, each and every single day, learned something new, and continue doing that year after year after year, almost like compound interest, right? So compound knowledge into compounding interest, and then it's only going to be beneficial with getting rid of all your debt, and you're at the place to be, and this is where it's at. So keep showing up, keep asking questions, and I think next is Jason.
Thank you, Kevin. Thank you, everybody. Welcome back to another Ask Me Anything. We're always excited to be here with each and every one of you. Drinking water, since we're going around talking about what we're drinking. Drinking water, no booze here either, even though that sounds like a good idea for me and Mr. BYOB up there in the corner. But anyhow, ask your questions. We're here to answer them. Come see us on the 3-day. I'll be talking about what your family, what happens when you're no longer here. We're always answering, bless you. We're always answering questions, solving problems for folks, meeting you where you're at, helping you map out where you're going in 10 years. That's why we love being here each and every week. And down to my buddy, last but definitely not least, Mr. Joe.
Thank you, Jason. So I'm Joe. I got coined the name HELOC Joe because I've been playing with HELOC since 2009. Been in real estate since 2000, private money lender since 2013, IBC 2019, been on the team for going on 6 years, traveling around the country, answering questions, helping people. And my first question is, why are we not in Brady Bunch mode? Why are we in little snippets?
Oh yeah, we are usually Brady Bunch.
I know the answer. This is our first question.
That's our
Steven
first
likes
question.
how he looks at 50 years old. That's why.
Even smart.
I was going to talk about Mr. BYOB's mustache. Like that's the big filter style. You hang it into the edge of your beer and it filters the beer on the way in.
Oh, I didn't know that. and I joked about what's in mine, but water. I haven't drank in over 10 years. Anything alcoholic.
Well, I wish there was bourbon in mine, I'll tell you that.
Well, cool. Let's get into some questions here. All right. The first one we got here is from Odin is the Sum Father. I think I'm reading it right. The Sum Father. What would the ballpark annual fees with a $500 per month premium with a minimum death benefit be and max funded with $6,000 be? So first off, I'm going to say one thing right here. You have something to say. I think it says IUL.
I don't know what those letters are. What are
I
those
don't
letters?
know why that's in the question. I'm going to go ahead and remove that because IUL is an infinite banking. Oil and water don't go together. So for Odin, when we do infinite banking, we use whole life policies for very specific reasons, which we will get into maybe on another question. But anybody else want to answer the fee question regarding this one?
Well, he won't be charged any fees directly, and the commissions and the insurance fees they're built into the.
Yeah.
So he won't actually see them. He's not going to have to pay a fee, not for us doing the strategy call, or not an additional fee on top of what his policy is written for. So if it's $500 a month, that's what he's going to pay is $500 a month.
Yeah. So think of this like car insurance. Like, what's the commission on a car insurance premium? You have no idea because they don't show you. What's the fees in that car insurance? They don't show you. It's built in. With life insurance or just insurance in general, the costs are all baked into the whole thing. So you don't really see those. There's nothing outside of the premium and the funding that is there in most cases. So there isn't one. Now I'm not understanding what you're saying. What the $6,000 is?
Is that a dump?
I'm assuming you're seeing annual premium.
No, I thought that'd be a dump.
I mean, 500 times 12 is 6,000. So he might be saying, if I do it annually, like the MOTA payment, right? If you pay your MOTA payment and you do annual, then there's less of a fee because I always explain it this way. Since you're an owner with the mutual company, you're paying your employee to service the policy one time a year. If you do it monthly, you're paying them to service it 12 times a year. So that's the difference. It's very small. I mean, you're talking about maybe $100 difference depending on the carrier for the whole year. So
the other big perk I would like to mention here about whole life is that your premium is guaranteed to never go up, to either stay the same or reduce. So it's very different than IUL, where there's internal fees constantly coming out of the cash value, and those are not guaranteed to stay a certain amount or anything. Those can skyrocket enough to where the premium you were expected to be paying is not even enough to keep the policy alive. So those are some of the dangers with IUL, and one of the many reasons that it does not work for infinite banking. It may have its own place and purpose for other things, but not for infinite banking.
Yep. There we go. All right. So Christian throwing out some ideas. Love it, man. Keep those coming. So just throwing this idea out. Yeah. Oh, I love the questions, man. So this idea out there to see what y'all's opinions would be. So if someone was in debt, but also trying to create cash flow different from their job, couldn't they leverage their savings to create cash flow to pay down debt and their monthly obligations? So a good question. So what Christian's asking here, I believe, is if you're in debt and you're trying to create more cash flow outside of a W-2 or trading time for money, can you leverage savings to create cash flow that would then be used to pay down the debt and also pay for monthly expenses? Now, I'll be on very quickly. This is not financial advice. We're not financial advisors. This is for educational purposes only, because that is a financial question.
No, it's not. It's a mathematics question. If you're paying 28% in credit cards and you have savings and you want to take this savings and you want to put it into an investment and that investment makes you 12%, aren't you losing 14%?
Yeah, or even
a mathematics question. You want to pay yourself first, get out of debt, get out of that 28% credit card, and then you can get into the investment realm because you're not paying that high interest of the 28. If you were taking your savings and putting into something that made you 50%, then I would calculate it out and see if mathematically if it would make sense. But if you're not making more than that 28% to cover that credit card, no.
Hey, Joe, I have an idea. What if you took the savings and paid off the debt and then paid yourself back the same amount plus interest?
That's exactly it. You have to invest in yourself to get rid of the 28 and then recapture it back.
I have two questions for the panel on this one, Matt. Okay. So, what's the first law of wealth?
Pay yourself first.
Pay yourself first. And I mean, we say it all the time, but it's a law, right? It's like gravity. Like you're not going to go walk off a bridge just because you're going to fall. It's going to hurt a lot, most likely. So it's a law. So you got to pay yourself first. That's the first thing. And the second piece is, when you're not paying yourself first, you end up as someone who's paying everybody else. Yeah. You're last in line for free money. So this is not like, instead of talking about the symptom, we got to really go to the root cause of what's happening, and it's the behavior of it. So then from there, you're paying yourself first now. And I like to say, you got to stop the bleeding. Like that's what Joe's saying. Joe's saying it's math, but man, you're just bleeding out. Like you're trying to work harder, hustle more, do more things, and you're not going to make any more money because you're just paying 29, 30%, 25% that's flowing out month after month after month. So stop the bleeding before you try to go make your money go to work for you.
Yep.
Great.
Yep. And the other thing too, when I was first getting into finance and I didn't know all this stuff, I had the same scenario, Christian, that you're talking about here. And I thought, hey, I'll take this money and I'll invest it. But then I did the math on it, fortunately. And I realized because of the returns I would get on the investments, the amount I'd have to throw out the investments was a staggering number. It was very, very high to create enough cash flow to pay off a very small amount of debt. I was like, it was so skewed. I was like, this doesn't make any sense. And then I was like, why is it this way? And then I dug into it because I didn't have any financial literacy. And I realized it's interest rates. Interest rates are disastrous. It is. And so, especially when you're paying them to somebody else instead of yourself. But great question though. And then Christian, I know you have a follow-up one here. Somebody want to add on?
Well, I just saw where he dropped in the bottom there. Okay, if you don't have credit card debt or car loans, okay, so he's kind of taking that at a bit of a different direction. One thing I was thinking about this whole time is like, if you're investing in order to pay off your debt, if you are, and to pay expenses.
Can everybody hear Linus?
You need to be super careful with what type of investment that you're going into and what kind of risk is associated with that. Because if your investment goes bad or just it stops paying for a while when you were expecting it to keep paying, you can all of a sudden be in a tight spot where you don't have the money even to meet your monthly living expenses because you were depending on that. So definitely got to be careful on what you set up, but it could be a good option.
Yeah, I mean, if you don't have the debts and the loans, I mean, invest.
Yeah, for sure.
It's what happens is people get it backwards. That's what I believe happens. Yeah,
they do, because that's the common advice. The common advice is go pay everybody else first, and then whatever little bits left over, go make a huge spread on it. But don't think about, what you've done short term and paying everybody else first when you're paying them interest and everything else. So
So here's something that came up one time. This is years ago on a conversation around this kind of stuff. So this client, they had debt, I believe. They had debt and they had a 401k and they had all this kind of stuff. And what ended up they kind of realized was that they're sitting here going and socking as much money as they possibly could into this 401k and an IRA too, by the way. And they had all this debt over here, and they had car loans, RV loan, motorcycle loan, all these toys and all these loans. And I remember this client said something to me that kind of made me laugh. He goes, "Man, I've got all this money I'm saving over here and all this debt over here. Why can't I just use my savings, my retirements for this over here?" And I'm like, that's called infinite banking, man. This is what we're talking about. That's you just described it. He goes, "Really?" I go, "Yes. Imagine if you could use your 401k as the bank for these purchases and still have the 401k growth with no negative years." He goes, that'd be the best scenario possible. I'm like, that's infinite banking.
Well, that's Joe's favorite moment. That means the light bulb came on in that moment.
Yep.
But it was funny though. We were on a phone call about infinite banking, and he described that, not realizing he was talking about infinite banking.
Right.
And it did click. I mean, after he realized, okay. But
You're back.
We should just call it our banking. Not infinite. Maybe we just call it our banking, right? Our banking system, the you and me big banking system, not their banking system. I don't know.
Yeah. And Christian, this is an interesting question. He had another one, is also what kind of deals actually exist in the market right now?
Check out the
I'm not in the
blueprint.
market, so I don't have any deals.
I'm not in the market either.
I'm not either, but I do have friends that are in the market, and if you know what you're doing, there's still deals to be made, I'm sure. So no matter how bad or good it looks, right? So
I have a mentor, an acquaintance of mine. His name is Andy Tanner. You guys may have heard about him. He's one of Robert Kiyosaki's guys. This is what he always said: what are the deals in the market? It's the ones that you make. And so what does he teach? He teaches options, how to trade options. And he goes, I make the deals in the markets through options because I control it. He goes, there are no deals in the markets unless you make them. That was his kind of I think is how he said it, but that really had an impact on me because I realized nobody is making deals unless you're actively doing something like day trading or options, or what you're doing.
Yeah, you know what you're doing.
That was
Understand that key statement. Know, like, and understand.
Yeah. Yeah, and he's good at options, by the way, and he has a good course on and stuff. And I want to go do it so badly, but I just haven't jumped on it yet. All right, hey, Lorenzo.
Oh, Brian, are you doing other stuff? Like, I mean, come on, man.
I used to do a lot of day trading.
You got all kinds of time. Right?
Oh yeah, so much time. No, I actually had a day trading course. I built a course that taught day trading, all that kind of stuff. So I used to do quite a bit of that, but not currently right now.
I was going to say it depends what kind of market you're looking in, because other markets like note investing and private money lending, there's certainly plenty of stuff, lots of opportunity there.
Mm-hmm. Yep.
Yeah, I was thinking about is the blueprint, right? Coming up, check out the blueprint. There's a lot of good information in there, a lot of good speakers, a lot of good presenters talking about what from, like you said, Lennis, notes to mobile home parks, real estate stuff. So definitely something to check out.
Yeah, Saturday's the big day for that. So for sure, make sure you're there.
Yep. Absolutely. All right. Lorenzo's got a good question here. Hey, all, what point do I start another policy? As in, what triggers that usually? And so let's kind of answer that first one, then we'll answer the rest of it.
Your bucket is full, right?
Yeah.
Can't put any more of your savings into that bucket. It's completely full. You're down to the base. Time to start another one, especially if you have extra cash flow and a lot more coming in.
Another reason to start would be that you had an unexpected windfall. And again, like Kevin said, you couldn't fit it in the bucket, or, like we for our family, our second policy, and I'll be talking about this on a couple things coming up soon. But our second policy was, okay, I have all the money that I paid back to myself from recapturing 9 of my 10 debts a month. And now I have this pile of money to pay off the 10th debt. But oh my God, I'm 5 times more protected than my wife.
Yeah.
What happens if she's not here? So then it's a protection play. So, our answer is always it depends, because it depends on what you're trying to accomplish and what you have available. But protection would be another piece of it.
Mm-hmm. Yep, 100%.
I think that's great, Jason, because even the kids, you want to get your kids started as early as possible too.
Yeah. And then one thing, Lorenzo, to keep in mind why we're saying this kind of stuff, and what we want to clarify here is that let's say you have a policy and you're funding it with $1,000 per month. You can't just suddenly just say, hey, I want to put in $1,500 per month or $2,000 per month. You can't arbitrarily change the structure of the policy. And I'm talking about the increasing premium because you're not qualified for that. They haven't approved that. That's why we cannot just change the existing. That's why we do the second policies. Just so you're aware of that.
Yeah.
Yeah, life events are a big common reason why we do second policies for sure. The second part of his question here is, and after my policy starts, am I able to fully fund the premium amount? And can I change the frequency of the payments to, like he's saying, like yearly? So yes, once you start the policy, you can change it from monthly to yearly, yearly to monthly, quarterly, semi-annual. You can change it, and you can also pay it up for like the next 6 months to the end of the policy anniversary. Is that correct? Yeah.
Mm-hmm.
Now the payments might not exactly be the same when you do that. Like let's say you have $1,000 per month, you do annually, instead of being 12,000, it might be like 11,500. So sometimes there can be a slight difference just on the calculations, but yeah, you can change that. And then Linus, have you seen that change in the premiums before when you change it to annual?
Oh yeah, it's just the lack of those monthly convenience fees essentially.
Okay.
Like for mine, I had one that I was doing $1,000 a month, and then when I switched to annually, I believe it was 11,860 or something.
Okay.
And sometimes, Linus, I mean, maybe talk about this for a second, but when you say you set it up to do monthly and say it's a fair amount, like say it's a rather large monthly amount, and then you want to change to annually, like 3 months in, you might not be able to immediately switch to annual and get all the money in right away because you've already structured a certain way. So it's kind of, they'll have to restructure it, I guess, to make it so it works, so it doesn't become a mech, because every time you do it, it's taking certain things into consideration.
Yeah, it's company dependent. Most companies, it's not an issue, but still at most companies, when it's in the first policy year, you can't be changing mode or only in certain narrow instances. So yeah, after the first policy year, that's when you have pretty much all mode options open to you.
Yep. And one of the things I saw is that when they changed it to annual, I think at the beginning of year 2, because they have more money in the policy at the beginning of year 2, it means there's more dividends coming in because there's more of a higher balance at the beginning. And so the annual premium was like 10,000, but they only allowed them to put in like 9,000 and change. They had to reduce the amount of PUAs by a slight amount so the dividends wouldn't push the policy above MEC. It was right at the border.
Dividends don't push a policy over MEC, so that was probably more an issue of, was it at One America?
Oh, I don't even know if it was One America or Life. It might have been a different company.
It would.
This is years ago.
They tend to have more challenges with MEC and annual when it was designed for monthly, but then it's just a matter of probably being able to put it in later in the year.
It might have been actually a Guardian policy.
Yeah.
Because I didn't do it. They did it before they came and talked to us. So
Yeah.
they had necked the policy by changing the premium mode. And and Guardian was like, hey, yeah, we told them it was going to mech it, and they did it anyways. All they had to do was reduce the premium a little bit, and it wouldn't have meched. But we weren't the agent, though, so there you go. Well, good question, though, Lorenzo.
Yeah.
All right, keep those questions coming in, everybody. So Scott King, you got a good question here. I love this one. So are the companies, and he's referring to the mutual insurance companies for infinite banking, are they FDIC insured? Or what's the FDIC? It's Federal Department of
Depositors Insurance Corporation or something.
Yeah.
No, they are not. They are not banks.
Thankfully.
What?
Thank goodness they're not FDIC insured.
Yes.
What? We don't get a sticker? Why not?
We do not want them to be FDIC insured because that means the federal government has their hands inside of it, which we do not. We want their hands outside of our banking system, not in it. So
and there's a lot of control around insurance companies, a lot more,
Yeah.
in my personal opinion, a lot more control than banks have. And that I can speak from firsthand experience because I did the audited statements for 35 years. And every dollar they tell you is being held for reserves is held by some kind of an investment that is audited and reviewed every single quarter.
Now, here's the funny thing about this question. I love this part of it. So you're talking about in a insurance company or a bank being FDIC insured. Well, that's an insurance company. FDIC is insurance, and we're talking about insurance. So if you go to a bank, traditional banks, by the way, have a thing called insurance to back them up. That's very interesting.
Yeah, it is.
So if you are your own bank and you are your bank with an insurance company, why do you need FDIC insurance? Because you're already with the insurance company. So but there's a longer answer or question to this one about FDIC insurance and how it can actually provide a false sense of security for people that have deposits at banks. And Tess, you know what I'm talking about. So you want to provide some input on that, what I'm talking about?
Well, and I guess, like you said, for banks, they're not required to hold the reserves. Like it's talked about in every single training that we have in our community, is that they could turn around and loan that same dollar 10 times. In the insurance industry, there's no game. I'm calling that game playing. Joe calls it devil's math, but we in an insurance industry, we operate kind of like on a liquidation basis. We always look at that we have reserves and investments right now at this point in time that every policy that we have will be covered if we were to close the doors today. And the banks operate, if you were to go to the bank, and they talk about it all the time, if you knocked on the door and said, can you give me the dollar I gave you yesterday? It's long gone. There's no money in a bank. It's gone as fast as you put it in there. Insurance companies, they hold on to it for dear life until we're forced to pay it. Until it's time to pay a benefit, we don't play the same banking game. I often hated when they compared banks and insurance companies because it's a completely different style of financial accounting.
Well, also the other thing to keep in mind with this question is that does the FDIC organization, whatever you want to call it, do they have enough funds to cover the deposits at the bank?
I don't think so.
What's the percentage?
They carry very little reserves in comparison to the amount of deposits they're supposedly covering.
I would challenge anybody who's listening to go look it up. Go look up how much is actually, protected, or how much money they actually have in the reserve compared to the actual deposits made. And last time I looked, it was like 1.21%.
Less than 5%. Yep.
Yeah.
So,
and 1.21% is significantly less than 5%, right? So, like, is it that little? Like, it's a very, very, very small slither of sliver.
And that's crazy. That literally
4 years back when
the entire country's funding, right? Entire country's amount of cash or money that's inside of banks is so big, and then the amount of insurance, because everybody knows, right? The question is, people have asked me numerous times, hey, is it FDI insured? Oh yeah, it's up to 250,000. That's what everybody kind of knows. Banks are safe up to that amount. But then when you find out that, hey, less than 5% of all the money in all the banks in the United States are actually insured by FDIC. So if we all took all of our money out.
Hey, and here's a question. If life insurance companies or just insurance companies in general are so highly regulated and got to follow all these rules, doesn't it make you think that the FDIC would have to follow the same kind of rules?
You would think, but
so,
no.
Does anybody remember a bank called Silicon Bank?
Exactly. That's what I was trying to think of.
Silicon Valley Bank.
They went under years ago. How much did the FDIC insurance pay out? They paid out pretty much every deposit with the bank. They did not limit themselves. They did not limit themselves to the $250,000. Right. So they literally, a bank went under and they scooped out, from my understanding, they drained their coffers to fund this one bank.
If you go back and look at that was in the beginning of 2023. And then there's two banks that were as large or larger than the Silicon Valley Bank that failed in that same 2-month time frame, right? And so the Signature Bank was another one that was $200+ billion, and then there was another 100+. The one thing I read, I remember researching this, and by the way, don't believe anything we say. Someone was calling us boring before and stuff like that. Cool, go look up this stuff for yourself. When you look up the Silicon Valley Bank, what I found, and I don't know this to be 100% accurate, but they were bailed out because a lot of very wealthy folks, government officials and other people, like I think even the governor of California had his money in that bank. So they bailed everybody out.
Yep.
And I think they
All of it.
changed legislation after that to not do it that way again because it was such a big deal, right? Sorry, Brian.
No, this is good. This is good stuff. This is where I wanted to go. Because then to wrap this one up, so 0 to 10%, what we've seen with the banks as far as how much they have to have on reserves based upon the deposits. How much do life insurance companies have to have on reserves based upon the amount of death benefit they currently owe at any one time?
Dollar for dollar.
All of it.
Yeah.
All of it.
100% cash reserves, which means they can pay every single death benefit at any point and still continue doing business because they are so liquid and so cash heavy. That being said, now you'd understand why wealthy families, politicians, and, well, us put our money with those kinds of companies.
Yeah, once you see it, you can't unsee it. And there's some really good wins in the chat I'm seeing and different things going on in the chat. This is super interesting talking about the Federal Reserve. And I mean, again, to make it super simple, life insurance companies, whole life companies are state ran by state statute. And that's how we want it. We don't want the federal, go look at our usdebtclock.org and look how much debt we're in and how much it's going up. You don't want someone that's that fiscally responsible for protecting your family with life insurance.
Yeah. All right. Scott King has another question here. What is the best ratio of death benefit to cash value? And he says 75-25 maybe. So I'll let someone answer this question, but to be very clear, so when he says 75-25, what he's probably getting that from is some of the videos that we have and content that's referring to the ratio or split inside policies. And that's not referring to death benefit and cash value. Neither one, by the way. The 75-25 is referring to the smaller number is how much of your premium is going towards death benefit. That's all that means. The 75 means how much of your premium is going towards paid up additions and term insurance. Not always term insurance, but definitely the PUAs. PUAs are what build cash value. And so if you want to know more about what I just said, attend our 3-day, by the way, because we'll probably talk about it there, or just hop on a call with one of us. And I'm going to put the link in here in just a second. And we'll break that down for you. But if anybody wants to address the rest of this question.
That depends on if it's a month by month. It depends on, are we putting in a dump? Are we overfunding the policy? By doing that, it makes the policy more efficient earlier. The more money that goes into PUA, it enables you to borrow it, and that's what the dividends are paid on. So that 25-75 is merely base to PUA. Now, what happens if I said, how about a policy that was 50-50, but you could still get 90% or more in year one? Is that going to be a 90-10? No, it's because of the way the ratio is for the dump in compared to the policy build. So I don't use numbers. I find out where the MEC line is, and I build it from there. I squeeze the orange until there's no more juice, and that's how you make it be efficient. It also depends on what are you building the policy for. Are we building it more heavy for death benefit, for legacy? Are we building it for a flipper who wants all the cash value and right out the get-go? So not one of these policies are built the same. Never one will be identical to another. Everybody's different age. Everybody has a different MEC line. Everybody has a different income. So everything is done individually, specially designed for you.
And when we're building that for you, like if that's the question right there, what's the best ratio of death benefit to cash value? We will have you answer what is most important. Like, are you stopping the bleeding? Like, are you paying all this interest to everybody else? So you got to pay off debt first. Are you, maybe in the third quarter of life where you're really starting to think about legacy? And now that's more important than the cash value. So like Joe said, it's specially engineered for you, but you'll have to tell us what's more important. And sometimes you can have your cake and eat it too. Like Joe was mentioning, a 50-50, nice big death benefit. Or Joe would tell you, here's another thing Joe would say. I got a lot of thoughts on this one. Joe would also tell you, well, if you're doing $100,000 a year annual premium deposit and you're doing a 75-25, well, your base is $25,000. If you're doing 6,000, well, now your base is way smaller, right? So it's going to operate a lot differently for what you're trying to do.
Yep.
So a lot of variables.
Yeah. And that ratio can actually, by the way, can change during the life of your policy too.
Yeah.
So whole new thing, but yeah.
You can't go on the numbers. It depends on what the algorithm is when we put in the numbers and what it looks like. That's the only way to do it. The 60-40, 50-50, 25-75 gets thrown out of the window when I build policies.
And we don't talk about that anymore. I haven't seen a video come out with those, looking at those in a long, long time.
Because it doesn't matter. It doesn't solve the problem.
Exactly. Yeah.
What
So
is
those
the
books,
problem?
we're going into the old archives.
Yep. All right. Here's a good question. Jay Greg says, can you put your paycheck directly into your policy and then pay your bills that way?
So
Short answer, no, but I'll let someone else answer that one.
So answer the question. Can you? Yes. If you're doing velocity banking into your policy, of course you could do that if there's enough of a hole. If you put in a dump of $20,000 to pay those credit cards, and now you take your paycheck, $2,000 a week or whatever, $1,000 a week, and you run that into your policy, the next month, could you take out $5,000 and use that for your bills the next month? You could. It just depends on what system are you doing. What are we doing? What is the problem that we're solving?
Yeah, because there's a yes, you can, but at the same time as would you take your Honda Accord and go 4x and up a mountain with it?
You could.
You could. But it's
What
not
he
going to be
says.
the best
Can you
fit.
put-
Yeah.
That's the question that he asked. Can you? Well, you could. It
Yeah.
depends on the system.
Yep. All right. So Roy here's got some good questions here. So he says, my policy is 2 years old. So awesome. Congrats on that one. Going on 3 years in November. And I would recommend that if you are interested in this, get started. There's only so much learning you can get from watching people do it.
How, Ryan?
I
How?
want
How
to give
do
him
you
an
get started?
applause.
Yeah. So I put a link in the chat box. Go ahead and grab that link and schedule a time with one of us, and we'll get the ball rolling and help answer your questions. He had another question here. It says, I'm still learning and playing around. So here's something I'm going to stop here for a second. So Roy is saying here, get started. I've been doing this for a couple of years, and I'm still learning. So that's the big part of this is never stop learning. So he says, I'm still learning and playing around with the utilization of my policy, and I'm learning more and more as I experience this. Such a blessing. Thank God for this, revealing this to me. So yeah, I appreciate you sharing that experience, and definitely.
You're awesome, brother.
Yeah, he was the one I was saying that you're getting some wins in the chat there, and it's exciting to see those because, and here's one. I had one yesterday where I had talked to a gentleman twice already. He had been on a bunch of webinars, and he had actually emailed me and said, Jason, I've been working since I was 14, man. I've never went longer than a week without a job. And he's roughly my age, right? He's like 48. So almost as old as us, Joe.
Yep,
And
almost.
and he's just telling me, he's like, man, I just can't get over the hump of this. And he makes plenty of money. He's actually got a W-2 job and has a business, and he's doing real estate as passive income. So he understands between good debt and bad debt. And at the end of the call, you know what he said? He's like, I got to go talk to my wife about this. I'm like, bro, no. Like, no, we've had 3 calls. You told me you want to do this. You told me why you want to do it. You just have to do it. Like, you have to have the application call, sign up, get it going, see if you'll get approved. And then once you come to there, we can come back together before it's issued. But you don't learn how to drive a car by reading a book. Like, you're not going to learn how to do something by reading a book. You have to do the thing. So that's the only way you're ever going to learn. Like, I was proud of myself, Joe, because I was like, no, bro, you can't do it this way. Your wife doesn't care. You're protecting her. Like, she doesn't care if you're doing this or not. When she's protected and you clear this debt by doing this and you show her it works, then she'll care.
See, at that point in time, I would have said, go get her. I want to talk to her too. Let's talk all together. Let's get this hashed out. What questions you got?
Yeah, for him, it wasn't that. It was just one more like, I don't know if this is going to work. Like, I need to see it before it works kind of deal. And so for that guy, you just have to do it. And that's kind of what Roy was saying earlier, right?
I like Dexter's question. Comment here. Ask him if he has to ask if he can make more money.
There you go. Good one, Dex. That's a good one.
I like that one. It's funny. Well, and I'll wrap up. I'll keep going with Roy's questions here. So he says,
I saw Brent. What happened with Brent?
Oh, Brent Burdick. Yeah.
You passed over him. It just popped up for a second and then went away. Right before Dexter. Yeah.
Oh, it's just a comment he just made. I thought it was kind of for people to read it. But yeah, he's just saying that, like as I said before, keep on learning. So Brent's on this Ask Me Anything, and Casey Nurse. Yeah, we do these live Q&As every week at the same time. So what time?
No, he's saying he goes on every week and he tries to answer the question before we do.
I like that. That's a way to play. Like, while we're all thinking about what we're going to say or what angle we want to approach it from or what comes present, that's a great way to learn for anyone. Brent, that's awesome. Anyone model what Brent's doing.
Yeah.
And you could replace me. Come on here and talk,
And if you go to in-person events, you'll meet Brent because he's been at a couple of them, him and his daughter, lovely people.
Yeah.
Yeah. So for everybody else who's, if your first time or second time, just keep on coming because this is how you keep on learning. We have a lot of clients that are on here asking questions and also hearing the questions being answered because it just helps them learn more. And then I was referring to this one here, but yeah, so we do these live Q&As every week at 4:30. Yeah, Eastern time, 1:30 Pacific for me. But yeah, we do them every week. So yeah, and then they're also recorded too, and they're in the Chris Noggle YouTube channel, so you can always go there and watch additional ones. But we've been doing these for Lord knows how many years, so quite some time.
Exactly. Chris Seeger is in the chat, and he says, "No replacing you, Jason Sipple."
Thank you, Chris. Thank you, brother.
Chris.
Chris is a phenomenal thinker, everybody that's here. I mean, one of the best thinkers and men I've met out there. And Chris, you better get your ass busy, man. You got some cool projects to bring to the world. Get on that, will you? And Liz knows what I'm talking about, most likely. So get working.
And then Roy just had another comment here. He has a policy with One America, and he pays himself $530 biweekly. That money flows through the policy first, and then using that cash flow for braces this year, and then start paying off credit card debt. So it's awesome. So doing all these things at the exact same time, still building the cash flow, still building the wealth, building the dividends, all that stuff while doing all this other stuff. Love it. It's awesome.
More money and better looking. Hey, right there. 2 IBC. More money and better looking. Straight teeth.
There you go. All right. So Dario has a question here. Says, Jason, I know dividends get paid yearly, so policy anniversary. But what about your regular interest rate we earn monthly with Lafayette? It doesn't show what I'm earning monthly. Will it only show what it is yearly? Well, there's only one rate, the dividend rate. But yeah, you want to take Jason?
Well, yeah, you can hit what you're thinking. I was going to tell Dario, contractually, everyone has every contract, every whole life special engineer policy, depending on the carrier. Contractually, it says somewhere in there what the guarantee is, right? So for Lafayette, it's a 2% guarantee. Your dividends paid at the end of the year. Your earning money, right, is actual, the ones that, at least from what I'm aware, it's paid daily. It's actually, you're earning it daily. So it's a cumulative number, that 2% over the whole year spread out. So it's growing a little bit every day, Dario. You just don't see it anywhere. And then you get paid the dividend at the end of that year. So
some companies pay attention to your values online, like say your available loan value, it does creep up throughout the year. So that's the one place you can see it. If your policy is on a monthly mode, that may kind of throw it off for about 2 weeks of each month. But if you check it on the same day of every month, you can readily see it.
Yeah, Patty and I check that every Tuesday in our money meetings. We go in there and we look at the cash value in each policy, and it's fun seeing it go up, $5, $6. Sometimes it jumps up a lot. I'm like, why'd that happen? We're always learning things. So
that's fun.
And also, every company is different. So to throw a whole other thing inside it, if you have like 2 different policies with different companies, they're going to function slightly differently, generally the same, but there's going to be little nuances such as the dividends and all that kind of stuff that are a little different.
And Dario, throw your restaurant into the chat, because I've been dying to get up there and eat at the restaurant. I know you got a couple of them. So when I talked to Dario and helped him, he was in the supply closet, and I didn't know what was happening. So the first time, so it's fun behind the scenes stories before you get started banking.
Love that. It's awesome. All right. So I think we got that question answered. We already answered this one. Yeah, the Q&As are done every week. Same time, same bat place. Let's see here. Lorenzo, another question here. Are the same requirements in place for children? So when you see children, I'm assuming under the age of 18, so 17 and under. Same requirements if you want to open a policy, medical, labs, etc.
Nope.
Same but different.
Yeah.
Typically, a juvenile will not need to actually do an exam, an insurance exam, but most other requirements probably still apply. Depending what's going on, they may still need to get medical records. Depending what's going on, they may still need to pull a driving record report and a criminal record report, just based on what they can see and, of course, the age of the juvenile.
Oh yeah. So I had a client that they thought that their juvie records were locked and couldn't be seen. Well, I'm sorry to tell you that the insurance company could see them, but they didn't disclose it to anybody. But the insurance company saw it, and it was supposed to be locked records, not public. But I don't know.
Well, in any case, the insurance company can't see the criminal records, but they can kind of see a generalized, like a code that tells them, well, there was something in this category, and then they want to know more.
Yeah.
They got denied. That person got denied. It was.
Yeah, I've had juveniles get declined because they regularly used nicotine and alcohol under the age of 21. So therefore it was illegal. And they're like, well, we can't, we just can't.
Yeah, that makes sense. And then there's a couple other things to keep in mind with juvenile policies or minor policies. There always is still the financial requirement to be underwritten, but it's not on themselves per se. It's on the guardian of the juvenile. So the requirements on an adult are on the adult typically. That's it. When it comes to a juvenile, then all of a sudden the guardian of the child comes into play. So their finances, their
existing life insurance,
cash flow. Yeah.
Yeah, we should say that too, Linus, that the parent needs a policy,
Yeah.
and then the child is eligible for half or up to $1 million. Or what are the
Depends on the company.
criteria?
It's up to half, up to $1 million typically. So
Or 100% up to 500,000 or $1 million. Depends on the company.
yeah.
Yeah, they're all kind of slightly different.
And there's no limit on $1 million for the kid necessarily. It's all relative. If the both parents have considerable coverage over, say, 2 million, then yeah, you can exceed $1 million in life insurance on the kids. But it just depends what scale we're playing in.
And which company goes up to 100% of the parent?
All of them do match the parent's coverage if it's small, like under 250 or under 500.
Okay.
Once you start going above that, now is when you're half of the parent's coverage.
Gotcha.
Make sure you check out the Joe, for you check out the financial underwriting guidelines for each of the companies. It's on the same document that you look at for, like, say, income replacement guidelines and stuff.
Cool.
And also, it can be state specific. I found this one out. So for New York,
Mhm.
Mass Mutual, 50% of the highest insured parent, which threw me for a whole other loop right there.
Right.
Yeah.
And you probably thought it'd be like 100 to 125%, but then you found out, oh, New York.
No, it's usually the lowest parent. So they usually will look at the amount of coverage on the least insured, guardian or parent. But this was the opposite. So I'm like, never mind. I'll roll with it. Just roll with it.
Because that's my first one with me and Ariana was with Mass Mutual. That's why I'm a little different with the other companies, because it's regulated differently.
Right.
Yeah.
I found the same thing out 2 years ago.
The great country of New York.
Yeah. The
I've
island.
had this one come up to where the kids, like, someone doesn't like needles. I'm like, well, when's their birthday? They turn 18 in 3 months. I'm like, get it done now.
Yeah.
But when they turn 18, the chances of them doing a medical are still very, very, very slim. And the medical is not, I mean, when you're young in your 20s, they don't, unless you're doing a huge policy, they get waived quite a bit.
I'm not too fond of needles either.
I'm like, whatever.
Yeah.
Toughen up, Buttercup.
All right. Good question. Next says,
Hey, I'm not a pin cushion like you, I guess.
You won't feel it. Don't worry.
What's next got?
So I think from finally looking and learning at my statement, does One America take dividends and buy more insurance?
Yeah, that's actually what you want to have happen in an
Yes.
infinite banking policy.
That's
Always
PUA.
have the dividends purchase more PUAs.
Yep.
Just really, really blowing up the compounding by doing that.
Buys three things, Dex. Always buys more paid up insurance first.
Mhm.
It gives you high cash value second, and it increases the likelihood of dividends third. Always in that order.
Yeah, and Chris, Chris is putting some questions or comments in here about Mass Mutual in New York, because New York is, it's a mess,
Yeah.
and only certain companies will do it and do policies in New York too. But yeah, he's saying that New York has limits for kids. Yeah, so he's given some different numbers in here and stuff. So yeah, it's just a case by case and basis. But yeah, love New York.
Yeah, I found that one out too. It was like 4 years, 6 months, and then 1 day, where you could do a larger amount. That 25% is below that amount. So if you want to put larger amounts in, wait till you're just over that 4 years, 6 months, and then 1 day.
Or just move out of New York.
Oh, and by the way, Liz, I had a client do that. They literally went. They had 2 residences, and they were New York resident. They went and changed it for infinite banking because of the difference. Now their policies were not small though, so keep that in mind.
Yeah.
But yeah, they went and changed it, and we went with a different company, and the policies were much better than what they had before. So yeah. Chris got another question here. It says, using my policies for the escrows on my rental properties, allowing renters to pay mortgage and a positive cash flow. The cash flow pays down the payment loans.
So
Any other
what
ideas
he's
for this?
that he's using the policies to pay out the taxes when he says the escrows. I'm going to assume that's completely separate. We don't know if he's saying he's got a mortgage, maybe he doesn't have a HELOC.
No, what they're referring to, I'm guessing, Chris, what he's referring to here is that you're taking taxes and insurance instead of a mortgage payment, doing it and escrowing through the mortgage company. He's being his own escrow and paying himself a monthly amount for taxes and insurance, and then paying it in one lump sum once a year or twice a year.
So now because he paid himself that, it's like he's not even paying it because it's still growing with dividends until he stops breathing.
And the renters are the ones that are replenishing that
Yep.
store. That's what I'm reading to this. Chris,
Correct.
like I said, you're brilliant. That's
Yep.
a good way to do it.
Yeah.
And you can do this. You can do this with all kinds of things. Like you can, depending on what you know, like, and understand, if you're using cash, like I helped a guy who did fix and flips on mobile homes, right? So he'd buy it for 15, 20 grand. He'd refurbish it for 15, 20 grand, do a seller finance for 5 years. And we actually figured it out where within I think it was 22 or 23 months, what the seller or the buyer was paying him replenished the $40,000 he spent while all that money was earning the whole time. That's very similar to what Chris is saying.
Yep.
Just it's a way to keep that money in motion, keep it growing, compounding for you. And a simple question to kind of guide you if it should go into a policy is, if I spend it doing this, will it ever make me money again?
Right.
If the answer is no, then you ask, well, could it? And then that's when we start having conversations with us.
There you go.
Yeah, another question I would have for him is he just have the mortgages, or does he have HELOCs as well? Or is he looking into potentially getting them for the rental properties? So then once at some point, those buckets are going to be full, the HELOCs are going to be paid off. He's going to continue using those policy loans, pay them down as well. So basically you're doing velocity banking on the policy loans, you're doing it on the mortgage, or you're doing it on the what you owe as well from the house and the mortgage. So good stuff, Chris.
And just Terry's question, I just want to bring it up here really quick, or comment. He just says his son has 1.4 million of coverage. So Terry's son has that much as death benefit is what he's referring to. And then he went and sounds like Terry got on his grandsons or grandkids 2 policies, 900,000 each death benefit, which they would qualify for depending on the company, of course, and state, because the parent has 1.4 million of coverage. So they can do that. Dex has a question here, says, so if a father has a bad record, maybe it's medical, maybe it's history, maybe it's criminal, can he insure kids instead? Yes, there's some stipulations and regulations around that and different things, but yes, there's options there.
My first thought really is going back to what you said about records, though, Dexter. We can have a confidential conversation about the specifics and take that to some preliminary underwriters at the insurance companies and just make sure maybe they would be able to offer something.
Yeah, because the insurance company, if you're insuring somebody else besides yourself, but normally you'd have to insure yourself first, they're going to want to know why you're not insuring yourself first and somebody else. Because there has to be justification called insurable interest. Obviously, grandkids, separate scenario though there. Let's see here. So let's see. Anthony's got a question here. I think this might be our last one. We're right at the hour, or half hour. So Anthony says, from what I gather, for seniors, policies are often limited to $250K death benefit or less, and annual premiums, sometimes $5K or $100K of death benefit. So first off, no, senior policies are not limited with what we're doing with infinite banking policies. They're not limited. And then so he's asking here, so $5K per $100K of death benefit. We're not limited to those types of numbers as far as I'm aware. Now keep it in mind, we're just talking infinite banking in these types of insurance companies. You go outside of this and go to other types of products, other insurance companies, they're going to have their own potential restrictions, but I don't know of anything.
Seniors policies tend to have a little bit more limitations to work with, but it is based on age and income. So it just depends. It's different for everybody.
So you have to understand that these are all still regulated by the IRS. So there's still limitations on them. So if you're a senior, 66 and older, whatever your income is, that's times like 10%, 10. So if you're making 100,000 and then it's 10, you have a maximum death benefit of like 1 million. So it's dependent on your income. That's where the age and the income comes in, because there's a grid of how old you are. 30, 40, 50, 60. They all change with how much, 20%, 30% is on your age. So that's where the limit is on the death benefit, and because of the income. That's kind of our starting point. Mm-hmm. And there's also a limit on how much you can contribute to a policy depending on your income, up from 15 to like 30+%. So that's also dependent on your income and assets.
Yes, I would say it's normally not really the insurance company's limitations. It's their underwriting guidelines and how they apply to you or the individual.
Correct.
That's what we look at, and that's going to be different for everybody. So, in most cases,
yeah, Anthony is certainly tracking. He says, "Okay, yes, I see 10 years of income." Exactly what Joe was saying as far as say being 65 and having 10 times your income that can be allowed in a death benefit. Absolutely.
Yeah.
That's why you have 10 years of income potential left statistically.
Mm-hmm.
I was going to ask Joe to explain that. So I'm glad Anthony picked it up and put it down.
Yep.
That just explains why the difference, if you're 21 and you're making exactly what that person at 60 was making, well, then you have 30 times, you have 30 times whatever your income is at that age compared to only 10 times at 60.
What is your earning potential left
for the rest of your life?
The rest of your life.
Yep.
Yeah, it's kind of weird. And unfortunately, what we think about is the opposite. We don't think about it when we're younger. We think about it when we're older, but the numbers are flip-flopped.
Yeah.
Mm-hmm.
So think about it when you're younger, actually, is what I wish I was taught. There you go. Well, it looks like we got through all the questions, unless I missed any.
Awesome.
Well, appreciate all the questions. As mentioned earlier, we do this Ask Me Anything every week. So 4:30 Eastern or 1:30 Pacific every Wednesday. YouTube, Facebook, all that kind of stuff. And once again, we do have the live event starting tomorrow. So I'm going to put in the link one more time. I think I saw it here. Where'd it go? I'm going to put that link here just one more time.
Yes, but not dump. Yes, but not dump. It includes the premium, but then you can still put in a dump, but then that's where the maximum death benefit will come into effect.
I had to go grab the link because it's not copying.
I just saw it. It's posted up there. Oh, gotcha.
Thanks, Tammy. Bald is beautiful.
Yeah.
I was going to say, you guys have some fans, and then I know you're
Yeah,
both
there you go.
married, so then I thought maybe not to draw attention to it. So
Shine. That's why I have my lights off in my
Gotta be
office.
proud.
There you go. All right. Well, appreciate you all being here. Appreciate all the questions. With that, look forward to seeing as many of you as possible starting tomorrow on our 3-day. But with that, we will see you next week. Take care, everybody.
Thank
Bye-bye.
you.
Take care.